Hello, my dear students. Lucas Commerce Academy, the power of accounting, welcomes you. Today, let us start a new chapter, joint venture. Joint means, in simple words, together. Venture means a job, a work. Joint venture means work together. Here, joint venture means it is an association of two or more persons to carry on business for a temporary period. For a temporary period. That means it is a temporary partnership between two or more persons. It is a temporary partnership between two or more persons. For example, A and B undertake to construct a building for a college. As soon as the construction of building is over, then the joint venture between A and B comes to an end. Comes to an end. In this example, A and B are called co-venturers. In joint venture, generally they do not use firm name. Okay, so the co-venturers contribute capital for their venture and share the profit and losses arising from joint venture according to their agreement. If there is no agreement, then they share profits and losses equally. Okay, so this joint venture business is done in three ways. In three ways. Number one, buying and selling of goods. Number two, underwriting of shares and debentures. Number three, construction works and any other similar nature. Okay, so now we are going to discuss the accounting treatment. Okay, so there are three methods. There are three methods for recording joint venture transactions for the purpose of ascertainment of profit or loss and the amount due to or due from co-venturers. Co-venturers. They are number one, only one co-venturer records joint venture transactions in his books. Second, when all co-venturers record joint venture transactions in their books. The third one is when separate set of books are maintained. Separate set of books are maintained. So now let us discuss the first method. In this method, only one co-venturer, either A or B, records joint venture transactions in his books. Okay, so this method is generally followed when the two parties are located at different places, Okay, so before we calculate the profit or loss and the amount due from or due to other co-venturers, let us take an example to understand the concept for doing the problems. Okay, try to understand this. If you know this example, then the journal entries and the problems quite easy for you. Okay, that example is A resides in Vijayawada and B resides in Hyderabad. A resides in Vijayawada and B resides in Hyderabad. A purchases goods for cash and send them to B. Similarly, B also purchases goods for cash and send them to A. Next, A purchases goods on credit and send them to B. Similarly, B also purchases goods on credit and send them to A. Next, A incurs expenses for sending the goods to B. B also incurs expenses for sending the goods to A. Next, A receives commission on his sales. Similarly, B also receives commission on his sales. Next, A receives interest on his investment. Similarly, B also receives interest on his investment. Then A incurs discount charges when advance received in the form of bill from B. Similarly, B also incurs or B also receives discount charges when bill received from A and discounted the same bill with his bank. Then A sells goods either for cash or on credit. Similarly, B also sells goods either cash or on credit. At the end of the period, Mr. A is not able to sell all the goods received. Some goods may be left unsold. Similarly, B also may not be able to sell all the goods sent to him. Some goods may be left unsold. This unsold stock is known as closing stock generally. This closing stock cannot be carried forward to next year, next period, as the business is going to close down very soon. Hence, we are not in a position to transfer to next period. Then what should be done? In this case, the stock may be taken over by A or B or both together as per their agreed ratio. Okay, so if you understand this example, then passing of journal entries and preparation of ledger accounts quite easy for you. Then let us discuss the accounting treatment. Okay, so here in the books of A, we are preparing joint venture account. Number 2, B account. How to prepare joint venture account? Joint venture account is nominal account. It is prepared in the same manner as in the case of trading profit and loss account. In this account, all expenses and losses are debited and all incomes and gains are credited to this account. So the balance of this account indicates profit or loss on joint venture, which is to be shared between the parties. Okay, so how to pass journal entries under this method? The first one, A supplies goods from his own stock to joint venture. The journal entry for this is joint venture account debtor to purchases account. A purchases goods for cash. Joint venture account debtor to cash account. A purchases goods on credit. Joint venture account debtor to creditors account. A incurs expenses for sending the goods to B. Joint venture account debtor to cash account or bank account. When A receives commission, joint venture account debtor to commission account. When A receives interest, joint venture account debtor to interest account. When A incurs discount charges, joint venture account debtor to discount charges account or discount account. Similarly, B also supplies goods from his own stock. He purchases for cash. He purchases on credit. When he receives commission, when he receives interest, when he incurs discount charges, for all these, we are going to pass only one journal entry. That is joint venture account debtor to B's account. So in this account, all A's expenses and all B's expenses are recorded. Then goods sold by A. The journal entry for this is cash or bank account data to joint venture account. Goods sold by B. B's account data to joint venture account. Stock taken over by A. Purchases or goods account data to joint venture account. Goods taken over by B. B's account data to joint venture account. Then balance this account, and this balance indicates profit or loss on joint venture which is to be shared between A and B as per their agreement. So in shortcut, in this account, what are the transactions are entered on the debit side, what are the transactions are entered on the credit side? All expenses entered on the debit side, that means A's expense and B's expense. Credit side, only two incomes are there. Number one, sales, number two, stock taken over. Okay, so the balance of this account represents profit or loss on joint venture which is to be shared between the co-venturers. Then the journal entry for advance received from B, cash or bank or bills receivable account data to B's account. When advance paid to B, B's account data to cash account or bank account or bills payable account. Suppose advance received from B in the form of bill, then the same bill is discounted with his bank. The journal entry for this is cash or bank account data, discount account data to bills receivable account. Okay, so these are the journal entries are passed in the books of A. Then B's account also is to be balanced, and this balance indicates the amount due to B or the amount due from B. Okay, so this is the first method. These are the journal entries and the ledger accounts under first method. In next video, we are going to discuss the second method, which is very similar to first method. Okay, thank you very much.